Have you ever wondered why some investors prioritize safety over chasing huge returns? What if there is a way to grow your wealth steadily while keeping your money secure from unpredictable markets? Today, we are going to explain bonds in a simple way, showing why stability matters more than growth and how you can make them work for your financial goals. Don't forget to like and subscribe so you never miss essential strategies to protect and grow your money wisely. 1. What are bonds? Bonds are essentially loans that you give to governments, companies, or institutions in exchange for interest payments over a fixed period. Unlike stocks, bonds do not represent ownership in a company, but a contractual obligation to repay your principal with interest. They are often considered safer than equities because they provide predictable income and return of capital at maturity. Understanding what bonds are and how they function is the first step toward using them as part of a stable investing strategy. 2. How bonds work. When you buy a bond, you are lending money to the issuer who promises to pay interest periodically and return the principal at the end of the term. The interest rate, also called the coupon, is fixed or variable depending on the bond type. Investors receive steady income, which can be reinvested or used for cash flow. Bonds are typically less volatile than stocks, making them attractive during market uncertainty. Understanding these mechanics allows you to plan for predictable returns while balancing other investments. 3. Types of bonds. Bonds come in several forms, each with different levels of risk and return. Government bonds are generally the safest, backed by national governments. Corporate bonds offer higher yields, but come with more risk depending on the company's financial health. Municipal bonds provide tax advantages in some regions. Other types include high-yield or junk bonds, which offer higher interest but carry greater default risk. Knowing the differences helps investors select bonds that align with goals, risk tolerance, and income requirements. 4. Bond ratings. Credit rating agencies assess the risk of bonds and assign ratings based on the issuer's ability to repay. High-rated bonds are safer and offer lower interest, while lower-rated bonds pay more but carry higher default risk. Understanding these ratings allows investors to gauge potential risk and make informed decisions. Choosing the right rating balances safety with returns, ensuring your investments are aligned with your financial objectives. Ratings also help diversify across different risk levels to protect your portfolio. 5. Why stability matters. Unlike stocks, bonds provide consistent income and preserve capital, making them ideal for conservative investors or those nearing retirement. Stability allows you to plan cash flow, cover expenses, and avoid emotional reactions to market swings. Bonds reduce overall portfolio volatility, providing peace of mind while still earning returns. By prioritizing stability, investors can focus on long-term goals rather than short-term fluctuations. Incorporating bonds strategically ensures your system of wealth creation remains resilient under changing market conditions. 6. Interest rate impact. Bond prices and interest rates are inversely related. When interest rates rise, existing bond prices fall, and when rates fall, bond prices rise. Understanding this relationship is critical because it affects the market value of bonds you hold. Long-term bonds are more sensitive to interest rate changes, while short-term bonds are less affected. Investors who monitor rates and adjust holdings accordingly can minimize risk and optimize returns. Knowledge of interest rate dynamics enhances your ability to use bonds effectively within your financial system. 7. Bond duration. Duration measures how sensitive a bond is to changes in interest rates. Longer duration means higher sensitivity, while shorter duration reduces price fluctuations. Investors use duration to manage risk and match bond investments to their financial needs and market outlook. Properly managing duration helps maintain stability and predictability in income. It also allows investors to anticipate potential losses or gains if interest rates shift. Understanding duration is a key step toward building a bond system that balances risk and reward for long-term success. 8. Tax considerations. Some bonds offer tax advantages, such as municipal bonds, whose interest may be exempt from federal or local taxes. Understanding tax implications helps investors maximize net returns. High-yield corporate bonds may be taxable at higher rates, reducing effective income. Strategic selection of bonds with favorable tax treatment can enhance the efficiency of your portfolio and support long-term financial goals. Considering taxes ensures your bond system remains profitable and aligns with personal financial planning. 9. Building a bond portfolio. A well-constructed bond portfolio balances risk, return, and income requirements. Combining government, corporate, and municipal bonds across different maturities spreads risk and maintains stability. Diversification within bonds reduces dependence on a single issuer and protects against default or market shocks. Investors should periodically review holdings and adjust allocations based on goals and market conditions. 10. When bonds make sense. Bonds are ideal for investors seeking steady income, lower risk, or preservation of capital. They are especially valuable for those nearing retirement, funding short-term goals, or adding stability to a mixed portfolio. Bonds also allow flexibility to adjust risk exposure without abandoning growth potential elsewhere. Understanding when and why to include bonds ensures your investment system works efficiently toward both security and progress. Now that you understand how bonds work and why stability matters more than chasing high growth, you can make informed decisions that protect your money while earning predictable returns. Apply these principles step by step, balance your portfolio, and stay patient for consistent results. Don't forget to like and subscribe so you never miss essential strategies for safe and effective investing that help you build wealth steadily and confidently.